All right, guys, so welcome back. Now we are going to dive into looking at accounting or trying to transact, journalize accounting for bonds payable. So in a prior video, we looked at when I, as in the company, is issuing a bond, when we're trying to determine the proceeds from that bond, will it sell at the face amount, a premium, or a discount? And as we mentioned in the last video, it really does depend on what you're offering the bond for in the marketplace and what similar bonds are being offered in the marketplace as well. Okay, so let's go through a few examples and let's just talk our way through accounting for bonds payable. All right, so on January 1st, year one, Eastern Montana Communication issued the following bond. So the face amount is $100,000. The contract rate of interest is 12%. And this bond is going to have interest paid semi-annually, which is June 30 and December 31st. The term of the bond is 5 years. So meaning after 5 years, the full amount of the bond is due, which is $100,000. And then the market rate of interest is 12%. Remember that market rate is those similar bonds in the same industry or things of that nature. What are they offering bonds for as well? Okay, and this is very important because it'll help us decide if it will be sold at a premium, discount, or face amount. All right, so with that, let's see if we can answer this question. Will this bond, based on this information provided to us about Eastern Montana Communication Inc., will this bond be issued at a discount, face amount, or premium? So pause it, look through it, let me know. So hopefully you guys paused it and you came up with the fact that it will be sold at face amount. And the reason it will be sold at face amount is because our contract rate, which is on our bond indenture, is the same as what they're offering in the market. Similar bonds are being offered. When they're both are equal to each other, it will be sold at the face amount, the full amount of $100,000. Okay, so now let's see how this transaction looks. So when we issue this bond out, Eastern Montana Communication issues this bond, we have to look at the journal entry, right? So whenever I issue this, I am hopefully in year one on January 1st, year one, I'm going to record cash, and the cash I'm receiving is $100,000. And then my credit will be bonds payable, BP bonds payable of $100,000. That's year one. That's me getting the money. Okay. So that's what I have here. Hopefully that makes sense to you. Now moving on, we need to account for interest, right? Remember, the only reason that the investor is willing to give you or the company $100,000 is not out of good faith because they want you to grow as a business, right? Slap yourself and wake up. No, the reason why they're allowing you to use their money is in return, you are promising to pay interest, right? It is a shaking of hands, and that's what the investor is looking for, okay? So according to this bond, it pays interest twice a year, every year for the life of the bond. So it's going to pay 12% interest on June 30th and December 31st for 5 years, okay? So now we need to calculate what does that look like, okay? What does the interest payments look like, okay? So here's our calculation here. It says every 6 months after the bond is issued, interest of $6,000 will be paid. So they've already done the transaction or the calculation for you. What they followed is something that should look very familiar, but it's the principal amount times the 12% interest times a half a year because it's being paid semi-annually. Now to journalize this, our journal entry is going to look like a debit, right? We're the company, so we're paying interest. So it's going to be a debit to interest expense, and then of the amount of $6,000, and a credit to cash. Our cash is going out the door, okay? So if my, there it is, okay? All right, so let's talk about, so this before I move on, this journal entry will look the same twice a year, every year for the next 5 years. So on June 30th, we're gonna have this journal entry. Sorry. On June 30th, we're gonna have this journal entry, and then on December 31st, we're also gonna have the same entry, and that represents year number 1. Year number 2, you're gonna have the same 2 entries, and year number 3, year number 4, and year number 5. Because again, the term of the bond is 5 years. Okay, so that's what the company is committing to. Now we need to talk about what happens when the 5 years is over. What does that look like? Right. So at this point, the investor has promised, sorry, you have promised the investor that, hey, after 5 years, I promise to pay you back the principal amount, which is $100,000, right? That was part of the agreement. That's what's on the bond indenture, the contract, right? So what does it look like after 5 years? Once you have used up the money and used it for whatever you need, you're going to do a journal entry to capture you repaying this this bond that you created, right? So your debit is going to be to bonds payable in the amount of $100,000, right? That was the original amount of the bond. And then your credit is going to be to cash, right? You have to pay that money back. If my S stays, there we go. Okay. And so that is paying back at maturity. So I have also captured it at the very bottom of the screen. Okay. So hopefully that makes sense to you. So now what we're going to do is do a breakout session and look at what this looked like. So make sure you grab the paper from the demonstration, that handout, and we're going to go through example number 1 in the very